Hello traders, Jeff with optionboxer.com, back again with another video that I think you'll find particularly interesting once we get into it. But before we do, please make sure you read the disclaimer at the beginning of this video and that you understand the risks inherent with trading options or in making any investment. And please make sure you understand that this video is not a recommendation for you to buy or sell any security or attempt any strategy. So we're going to look at positive expectancy today. And in particular, we're going to look at setting up a positive expectancy trading system or trading plan, and then we'll kind of delve into that as we get through the video here. But most importantly, with this, kind of what we're going to look at today, these three hypothetical trades, is figuring out where to put our stop loss. I know that's always a kind of a hot button issue for traders. They never really know, or maybe they do if you have a sound trading plan, but it's never really set in stone, again, unless you have a trading plan, where to set your stop loss. Because at some point we've all seen a trade go way against us and then come back and end up being profitable, or more than likely it's gone against us, we've closed it, and then it comes back to be profitable. So we're going to use the probability out of the money here, and again, I know I could click this, analyze the trade, and look at the exact probability at expiration of this finishing out of the money, but for the sake of time and the sake of this video, the probability out of the money here will suffice. And so we're going to hypothetically say we've got a trade set up here at 62.50 short and 65 long call. And that would net us a credit of $1.82. And so I've set that up here on this page, on this Word document, 62.50.65. So if you do some simple math, and before I do this math, I should make sure I tell you, this information is from Tastytrade. I watched a video from them earlier this week, and while I've put into practice this concept, I guess I've never really sat down and thought about it. And so it was nice to see the math behind it. Very simple math, as you can see on the screen there, and but very powerful kind of in what it I guess highlights. And so that being said, you got $1.82, and you will have noticed that there was a 24%. So if the probabilities held true through 10 trades, we would win on 2 out of 10. All right, which means we would lose on 8 out of 10. So if you do 182 times 2, assuming we held these till expiration, we would gather a maximum profit of $3.64 or $364. And if you divide that into our losing trades, that means we can set up this. If we were going to trade this in the money call spread, we could only lose $45.50 on each of those losing trades in order to break even. So realistically, we'd probably want to set our stop loss at about 35 to account for any commissions or any fees that may go into it over the course of these 8 trades, maybe even less than that, depending on what your commissions are. But not ideal. You're going to cut. You could potentially cut off every possibility of this being a winner, because your stop loss would have to be so tight. That being said, it's going to be more difficult because it is further in the money, and you can see here it looks like there is a maximum loss of, let me do the math, looks like a maximum loss of $68. So it would you may end up cutting off a potential winner there. So I don't love trading this in the money. If I'm just going to go ahead and speak ahead of time a little bit, the most ideal scenario would be right here. And then the highest stop loss point would be if you were trading out of the money. But let's look at each of these. So we have 67.50, 70 strike there. So let's go ahead and set that one up right at the money. And you can see we're collect $1.12 in premium. And if this probability held true, this 67.50 is right at 48. So I just kind of rounded up to 50%. Because it ends up 48% and 52%. So call it a 50-50 shot that we're going to win or going to make a profitable trade there. So if you did 112 times 5, that ends up with a total profit of 560. If you divided 560 by your 5 losing trades, you would end up with 112, or $1.12 would be your maximum loss. So on this trade, we've got 250 minus 112. Maximum risk of 138. So you could almost hold this trade all the way till a maximum loss and still close it and keep a positively expectant trading system. And so that's why I think this one is probably the most ideal, just because if you do have, and this isn't assuming any technical analysis, any fundamental analysis, any real analysis of any kind, other than just looking at the probabilities of the trade, and of course looking at them over the course of 10 trades. So that would probably be the most ideal scenario, but you would want to try to pull this back a little bit to maybe an even 100, maybe even 85 to 90, just so you make sure that you are on the positive side after these 10 trades. Hopefully that makes sense. And then the final trade I had set up here was 72.50.75. I won't set it up on Thinkorswim. But it was a 51-cent premium, and if you look at the probabilities here, it was at 73. So you got to assume you'll win 7 out of 10 trades, and that would net you a profit of 357 if you won 7 out of those 10. And if you lost 3 of them, you would take the 357 divided by 3, which means you have a max potential loss on each trade of 119. But worth noting, so I will actually build this here. But worth noting, you have a $200 roughly, or $249 I get, or I'm sorry, $199 potential loss there. So it's you're staring down a larger potential risk to reward or loss to reward ratio there. So ideally, you would want to set this up right at the money somewhere, and realistically, it may be better to trade this 62% here. And we can do the math on that. Let's do the math on that really quickly together. So this is the 72.50, just out of the money. We have a credit of 79 cents, and it looks like we'll win 6 out of 10 trades. From a probability standpoint. So what did I say? I can't remember now. 79, yeah. So 79 times 6 equals 474. 474 divided by 4 equals 118. So that is your most ideal. That is your most ideal setup right there, at least in terms of creating a positive expectancy trading system or a trading plan. You could potentially lose $118 on each trade and still break even, which gives you plenty of wiggle room, in terms of letting this trade kind of stay on the books until it either goes profitable or until it's going to go into a loss situation. So if you can hold it till, let's go 250 minus 79. There's a potential max loss of 171. It looked like, if I remember correctly from what my brain here just told me. So you could hold that for quite a while and let it kind of do what it's going to do. And let's just say we took that to 100. Made it 100. You lost 4 trades at 100. You would lose 400. But if you held 6 trades and you made the maximum profit, you would make 474, which would net you a profit of $74. And while that doesn't seem staggering, think about this: if you took this on 100 trades, well, that 74 now becomes 740. All right. What if you took 1,000 trades? Now that 740 becomes 7,400. All right. What if you did this on 10,000 trades? You can see where I'm going with this. Just start adding zeros, and so if you set up this positively expectant trading system, you can see the power start to work itself out. And there's nothing stopping the trader from setting up a different trade on every single thing. And again, this isn't assuming any technical analysis, so you can only probably further improve your odds of success by some reliable technical setup or technical indicator. And you can see the power as you start to add zeros. If you did 100,000 trades, just to add another zero there, you can see how this starts to magnify itself quite a bit. and before you know it, you're in a pretty lucrative situation. So that's it for this video. I just wanted to show you this very quickly. I think it's certainly a powerful concept. And again, all the credit goes to Tastytrade. They were that's a video I watched that they, I think it was Mike on Tastytrade, shared this information. And so I thought it was very impactful, or at least it was for me. And it's certainly something I'm going to look at going forward. But if you have any questions, feel free to reach me in the comments, or you can always reach me at optionboxer.com. See you later.